There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors. We have Ryan Detrick on the line. He is an independent trader and market technician and a guy that does a lot of homework and makes my job a whole lot easier. Ryan, how you doing this morning?
Hey guys, I'm doing well. I'm a Bengals fan, so it's the last night I'm not doing perfect, but I am doing, I woke up this morning, so it's still a good day.
Okay.
Well, feel the pain. We're in Detroit, so it was a real bad day.
True.
Detroit sports.
Yeah, we won't lie.
We won't even talk about sports. We're not talking about sports today.
It must be that
Good.
whole cat thing, Lions, Tigers, and Bengals.
Stop talking about sports, Joel.
Okay,
I can't take
sorry. We were just talking a little bit about the positive ink and barons on some of the grocery stocks, and one of our traders, Nita, asked about Safeway here, and boy, this stock, SWY, this has been trading in a really, really tight range after a drop down. Is there something going on with this? Is there a merger or someone taking them over? Because look at this. Is this right, this activity here in SWY? It doesn't look like it's going anywhere.
Well, yeah, I'm looking at the same thing you are. It hasn't gone anywhere. I mean, it's not a name, to be honest, I follow that closely. I know that I'm in Cincinnati here, and the Kroger's the big name here, so I know grocery stores have been doing very well. Every time we have a rough winter, everybody panics and goes buys a bunch of stuff in the stores, it seems like. But with this one, yeah, it's definitely a very tight consolidating range. You got that 50-day just kind of hanging out right at the 50-day, not quite able to get up above it. But when you see these tight congestions, I guess there is always that potential for some type of activity or news that can really bust it out with those tight Bollinger Bands.
Ryan, talk about the Kroger here. It's actually breaking out here this morning. Got some positive ink in Barron's over the weekend. It's breaking out to new highs here on the move. Made a great move there on Friday. I don't know if that was the pre-Barron's pop on Friday, but holy cow, it's up here again here this morning, trading over $53. What are your thoughts here on Kroger?
Sure, Kroger's one I know a little bit better. Like I said, it's kind of a local company. I mean, the thing that I've seen with this, I'm not a big fundamentals guy, but I can tell you on Kroger's front, they continue to have really good earnings for a grocery store. But at the same time, they're actually looking to expand. They've bought some smaller companies down in North Carolina. Again, they're based out of Ohio, the Midwest, but they're looking to expand, looking to continue to grow. And it's just, slow and steady. I mean, you say slow and steady wins the race. By no means is it a sexy name, but you look at that chart, nice, steady uptrend. And, yeah, that is interesting with Friday. I think somebody might have leaked that when you look at that bar on Friday. But nonetheless, I mean, it's just, it continued good management, and things just keep working for it. Slow and steady. It looks awesome still.
Okay, Ryan, you'd like to do work on seasonality and trading patterns, and it's getting a little tricky here. Could you talk about what you're looking at as far as the markets and seasonality?
Sure, that's right, Joel. What I did just last week, I looked at, what the average year in the S&P has done since 1950. And what I found was kind of interesting. The average year, again, we're just talking averages here, peaked on September 19th, and it doesn't really bottom again until October 26th. Now, we all know that's kind of standard. It's, late September weakness, October volatility. But when you look at this year, we peaked on September 18th this year. We've had a little bit of a pullback the last couple of weeks. So, just from a purely seasonality point of view, the next few weeks are concerning. Now, the recent 2 weeks we just had were the 38th and 39th weeks of the year. And I went back again since 1950. The 38th week of the year actually was hands down the weakest week of the year on average. So we had the down week. And then last week, that 39th week was the 10th weakest week on average. So all the seasonality stuff coupled with what we saw, at least a couple weeks ago with the new highs, a lot of excitement. The Alibaba IPO, a lot of the sentiment polls getting excited. When you couple that with the weak seasonality time frame, to me, it was ripe for the pullback. And I know small caps have pulled back, almost 10% from the highs. S&P was close to, 4%. But still, we're still kind of in that troublesome area. But the thing that I thought was interesting, again, you talk about October. We all know the scary October stats. Sure, go ahead.
Do you mind if I show the information that you sent me? I just wanted to see if it would be okay to put that up on the screen.
Oh, anything I sent you guys last night, you feel free to interrupt there as I'm talking about it. Absolutely.
Okay. All right. Just to get going back here. Okay, so you're talking about the seasonality. Did you move on to October when you were talking about October now?
Yes. Yeah, okay. I kind of got into October, so let's see, that's I guess the third couple charts in there. But, what happened with October, I looked again, since 1950, it's the sixth best month. So you could say it's an average month. It gets all this negativity because we know 8-7 crash and all this other stuff, but it is the most volatile, had the higher standard deviations. I didn't find that too shocking. But then you get into the whole presidential cycle thing, first year, second year, third year, fourth year presidential cycle. We're in the second year of the presidential cycle. Interestingly, October is actually the strongest month of the year. And then you get into November, December, they're the second and third strongest months of the second year of the presidential cycle. So what I'm getting at is, this year has kind of been obviously frustrating for a lot of people, but average second years of presidential cycle really look like this until you get to that fourth quarter, and then that fourth quarter is really strong. And if you look at all the 4 quarters of the 4 years, so 16 quarters over a 4-year presidential cycle, the fourth quarter of the second year of the presidential cycle, so where we just started, last week right now, is the strongest on average. It's up over 8% on average. So, again, we're talking, near-term seasonality, sure, maybe there's some worries, but we are getting into, guys, the strongest quarter, and then next year, the first quarter and the second quarter of the third year of the presidential cycle are also the second and third strongest quarters. So these next 3 quarters we're in are historically very strong. Now you can say, why is that? I guess we have midterm elections coming up, and there can be, sometimes some gridlock, indecision when that happens, and we all know the stock market usually likes indecision or gridlock, and, that's just one theory. But, hey, bottom line is, I know things aren't perfect, but seasonality still looks real good the next couple quarters out, in my opinion.
And we are usually strong into the end of the year, like you were pointing out, over the past 50 years. It's interesting to see it on the numbers there and see the 1.15% average return in November and the 1.54%. They call that the Santa Claus rally in December when the stocks really start to take off. Towards the end of the year, the retailers are often stronger, as obviously we're coming into the Christmas season, which is the strongest season for them. So it's always interesting to see the actual numbers when it coincides with what is often said about that time of the year.
Exactly. We all beat the death cross to death recently, and, the stats in the death cross on that Russell kind of said it really wasn't as bearish. So, but it is neat when things kind of line up. And you talk about, the retail crowd getting in and money. I mean, one of the other charts I sent you guys there that kind of jives with that is that NAAIM exposure index, is what the active managers are doing. And it just came in at the lowest level this year. So again, the active managers kind of are getting out of equities a little bit. And it makes sense. Market's going down, been choppy. We know all the scary headlines. But from that kind of contrarian point of view, with that seasonality point of view, you're looking for where is the next money going to come from. That kind of pushes higher, I guess, for the end-of-year rally that I kind of think will happen. It very well could be from some of these active managers that are getting out of the market. I didn't send you this chart, but I know the 8-week moving average of this NAAIM survey actually is the lowest it's been since late last year. So you can get volatility any one week, but a nice long-term 8-week moving average, it says, the active managers are getting out of this market, and that's historically the last couple of years, actually, from, that contrarian point of view, usually when you want to be kind of dipping your toes in. So it's interesting, it's a 4% dip, how much worry there is. I'm aware most people are down much more than 4% because they're in small caps and things like gold and that. But still, I'm seeing some things all of a sudden line up late last week, where the fear is coming back, and it's kind of been where you might want to dip your toe back in.
And isn't that the way, like as a trader, I'm always trying to figure out what the major herd is doing. Like, what is everybody else doing? If they're all scared out there, that's often a sign where we might be coming to a market bottom. We saw that last week with Ebola when we really tanked 2 days in a row, got all the way down to S&P 1918. And then what we've seen in the last 2.5 days, we've got back over half of those losses. So when everybody's fearful like that, you often do see a short-term bottom, and that's exactly what we saw last week.
That's right, Dennis. And, one other neat sentiment stat that I did send you guys, the CNN Fear and Greed Index. Now, I don't exactly know how they compose this, but it's proprietary, their sentiment index that CNN Money created. But anyway, the Fear and Greed Index last week went down to 3. Now, it goes from 0 to 100, so 3 is obviously extremely low. And I asked some of the guys I know over CNN, I was like, hey, 3 is pretty low. What's the lowest it's ever been? And they said August 2011, so the debt issues and the U.S. government problems we had in August 11, it went down to 0 then. Now, you look back, that wasn't the worst time to be buying equities from a longer-term point of view, August 2011. But, so then we just went down to 3. So that's just one indicator, sure. But that that one, and I like that one because the CNN, I think, kind of gives what the crowd, the average retail guys think, and not the more sophisticated. And I hate to say we want to pick on them and do the opposite, but maybe we do to a degree. So the average guy's reading these headlines, worried about earnings, worried about Ebola, worried about whatever else you want to pick. And if we get any positive news, and let's be honest, earnings season's coming up, we're seeing the same thing we've seen for 3 years now, where earnings, the estimates continue to be cut down. What about 6% year-over-year growth is what's expected. Some pretty smart guys I follow are looking for 10% growth again. Brian Gilmartin over Trinity Asset Management, who's really good at earnings, he's saying he thinks 10% is possible again. So once again, I think we're lowering that bar, and good earnings could be what drive the fourth quarter, like it usually does.
Ryan, let's go back to that first chart that you sent last night, and you said that the average year we peak on September the 19th. This year we peaked on September the 18th. And just thinking, sometimes you see these numbers and they line up for reasons, and that was quadruple, which was September 18th this year. And obviously we have the third Friday of the month always falls between the 15th and the 21st of the month. Do you think that's something to do with it? Because we often see where moves get extended, you have major players who have large option positions, especially within the third quarter, where they're actually on the September when they got the futures expiring of the overall indexes too. That was a quad witch. Do you think that is maybe one of the main reasons why those numbers are there, that just happens to coincide with a very volatile trading day?
Sure, yeah, I do, in a nutshell. And, you can look back at other option expiration weeks or option expiration. September is probably the most volatile one. But, again, because I mentioned that 38th week is the most bearish, and that's kind of when that falls into time. But usually you do see a little more volatility with option expiration weeks. And we've also seen some major turning points, whether it be peaks or bottoms the last couple of years around options and futures expiration. So when you couple it with, the fact September obviously is the end of the third quarter, so you're also getting people playing with the end of quarter things, it all kind of focuses in on that. And then obviously the Jewish holiday is kind of right around that same ballpark time also, where you can get a little bit of activity or lack of activity, I guess, usually selling around that also. So yeah, there's a couple of different reasons, but I do think in a nutshell it is probably all the option futures that are expiring right around that point of time. I think it makes a lot of sense.
So how are you?
It happened again.
Yeah. So how are you approaching the markets this week? We've had the bounce from the Ebola the last couple of days. We're back up here, rallied basically 50 S&P points in 2.5 days here, coming into an area where we had some resistance here before. Is this bounce too much too fast? Do you think we go sideways here this week, or do you think we could possibly give back some of these gains?
Well, I think we give back some of the gains. The one thing I didn't like seeing is, we had over a 1% rally on Friday, and we've only had a handful of 1% rallies. Usually what you see, at least in this bull market we've had, is, kind of slower and steady wins the race. A bit bigger move is a little more, setting's the right word, but a little more concerning. Now, that second chart I did send you guys, the S&P 500 is cash with the 120-day moving average. I'm fully aware 120 sounds random to me, but, a lot of people have been noting this. We just went right down to that. We've touched that thing 5 times since late 2013. This is the 5th time. And, is the 120-day moving average the magic number this year? I made a joke on Twitter that, something no one said at the start of the year was the magic number is the 120-day. And, people are sort of talking about it now, but, hey, it's right there with some of the fear things I just kind of talked about, where they're starting to flash some previous areas of bottoms coupled with this level right here. But, bigger picture, or a more near-term picture, I guess. The next couple of weeks, I still think, October's volatile. Stephen Russolillo just wrote something in the Wall Street Journal today. I think 9 of the last 13 days on the Dow are 100-point move. I know you need to look at a percentage basis to get a true feel. But still, volatility is clearly coming back all of a sudden, and all of a sudden, but recently. And I think that could be the case to stay. And usually a lot of volatility isn't always good for the bulls. I'm not saying we have a huge sell-off, but I think, a little choppiness frustrate people, and maybe get that late October low. And, I'd mentioned the most bearish weeks, the 38th week, and you mentioned Santa Claus rally, just a fun little stat. The 52nd week, last week of the year, is by far the most bullish week, up over 80% of the time. So, there is some, we say the Santa Claus rally, this and that, and there is some actual truth to that stuff sometimes when you go back and actually test it.
Ryan, are you a fan of any of the Fibonacci's or any of the retracements? Dennis and I like to follow them. We're not so much the .382 or the .618, but we both just kind of like to, keep a focus on the 50% retracement for rebounds reversals and trends. Now, right here in the S&Ps, you're back up in a couple days. You're retaking this 1966.50 level. How much significance do you put on retracements?
Sure, I do. I mean, I watch them just like everybody else, and I kind of want to know what the crowd's talking about. If I know other traders are watching, I think it's important. So there is something there. Now, one thing you talk about 50%, retracements. The VIX actually just spiked about 50%, and one thing I've seen the last year or so is VIX spikes approximately 50% from the lows. It kind of marks some blow-off tops and volatility, and then we kind of saw that implosion late last week. So that's a 50% number that I tend to watch also with the VIX there. But all in all, I mean, I've seen some of the bigger charts, going back years where these Fibonacci numbers nail some major lows. I know the big one that gets me is the 82 lows to the '07 peak. It bottomed right at 666. One of the Fibonacci's pulled right back to that area on a big, 30-year chart. So when I see things like that, I'm like, oh, probably should be paying attention. But I like to pay attention on a much bigger term. I'm not by any means a day trader. You see stuff I'm talking about. I'm more of a swing trader, intermediate term guy. But bigger picture, I think it makes sense to pay attention to them, no doubt.
Ryan, isn't that? I was going to ask you. Isn't that kind of the key to lengthen your time frame in this market here a little bit? Because I've been with Bright Trading here for 15 years as a prop trader. I've seen a lot of traders come and go, and the traders who are doing very well in this market have actually lengthened their time frame. We used to all be short-term traders, almost like high-frequency traders, where we're trading very short-term scalpers. And it seems like that market, the high-frequency traders, kind of monopolized that part of the market, where if you've lengthened the time frame, though, they don't seem to compete with you as much. So isn't that a little bit more key of to be successful in this market, is to lengthen that time frame?
My opinion is absolutely. I used to be more of a shorter term time frame guy also, and you can have all these intraday volatility, all these other traders doing things, and I think it makes sense, at least for me, and maybe for others, to definitely do that. I mean, there's always something moving, there's always a sector happening, but lately, in the last couple of years, it just seems like lengthening your time frame, whatever that might be. I mean, for me, it's a couple of weeks, or maybe now I'm maybe a month or so, but it just makes a lot more sense to me when you have all those trades going off, like we talked about during our options expiration, all these trades going off, a lot of activity, a lot of volume. It can shake you out, and I've seen it firsthand with myself, where I've definitely been shaken out of many trades before. And sometimes having a little bigger term perspective on things is a nice, refreshing way to look at it and not be so into the day-to-day volatility. It's easier said than done. Trust me, when we live and breathe this stuff. But
right.
I think for sure that's the way to go. Definitely.
Okay, Ryan Detrick on the line, market research and technician. He's on Benzinga's pre-market prep, brought to you by Charles Schwab. Thanks a lot, Ryan. Great information as always, and hope to have you back on again soon.
I appreciate it. Thank you, guys. Have a good one.
All right.
Thanks, Ryan.